Hey, welcome back to Accounting 604. We are now in Module 6, and we are looking at analyzing and understanding various types of long-lived or long-term assets on the balance sheet and what the analysis of those kinds of things might suggest to us in terms of insight and understanding the underlying stories hidden or beneath the numbers of this section of the balance sheet. And what we mean by that is on most balance sheets of most firms, what you will find is a recurring phenomena of the largest assets you'll find on the balance sheet, those being accounts receivable, PP&E, goodwill, and this last category of inventory. And that's what we're looking at in this deck. As you can tell from the slide, we're looking at the reported flow of costs. So let us conceptually first consider what we mean when we're talking about the flow of costs. This is an illustration from the textbook on this slide, and you may recognize this from a prior deck. I think all the way back to module number 2 is when we began to talk about this concept of when we have assets acquired by the firm, how quickly are they used in order to produce revenue? Again, a reminder, the primary and fundamental reason why an organization will acquire assets is to generate revenue. And simply the question becomes, well, the cost of those things, are they used up relatively quickly within the period to generate or support the generation of revenue? If so, those costs are expensed directly on the income statement. That, of course, would be the lower red line you can see in the diagram that sort of avoids the balance sheet, right? It ducks under the balance sheet, ends up as expenses on the income statement. However, if those costs are not immediately in the period used up, those assets aren't used up immediately, then they are capitalized on the balance sheet. You can see that the longer lived types of assets that you see in the upper half of that little diagram on the left, those things aren't used up immediately, so those costs appear on the balance sheet. They're capitalized, and then slowly, as they are used up, the use of those assets show up periodically as expenses on the income statement. As you can see there noted then, right, if the inventory is purchased or produced, when inventory is purchased or produced, it is capitalized on the balance sheet. How does it then eventually show up as expensed on the income statement? Well, with inventory, it's when the inventory is sold. Then its cost is transferred from the balance sheet to the income statement as cost of goods sold, which we by now recognize as with the acronym COGS, cost of goods sold. And so the very first thing you have to understand is what we are talking about is the theoretical flow of these costs, especially inventory costs, which will flow first onto the balance sheet and then slowly, as they are sold, itemized out as expenses, specifically as an offset to revenue, right? A contra revenue account, cost of goods sold. And so the capitalization of inventory costs, you can see here that the textbook definition of capitalization, meaning that a cost is recorded first on the balance sheet and is not immediately expensed in the income statement. Well, for purchased inventories, the amount capitalized is recorded at purchase price, at our cost, the firm's cost of acquisition. And for manufactured inventory, which of course we would sort of conceptually think of as you purchase the raw materials or the component goods, and then there is also labor involved through your operations to take those components as inputs and to add value, and through the expense of labor and expertise, they are then transformed into finished goods, right? And so you see for manufactured inventory, we capitalize all the manufacturing costs, which consists of these three components. Raw materials, of course, the inputs, right? The cost of the inputs, the cost of the direct labor expense to manufacture the project, and then, of course, manufacturing overhead. Right? So those three primary components go into the transformation of inputs into outputs. Now, what happens when we are specifically talking about this flow of all of these costs? Well, this diagram attempts to show you what is going on, and we sort of read this from top to bottom. And so in the beginning of the period, you begin with a level of existing inventory. Now, let's be honest, of course, if you're starting from scratch, your beginning inventory is 0. But every period after that, we presume you will have some inventory from the prior period. It's very rare that an organization would sell out all of its inventory and start the next period with 0. So you have typically a beginning level of inventory period from period, which of course beginning inventory for this period is exactly the same as ending inventory for the prior period, as you might guess. Now, to that, we add any inventory that we acquire during the period, through purchases or through production or both, right? And that then, the beginning inventory plus whatever you add during the period equals the purple rectangle, the total available costs for sale, the cost of goods available for sale. Now, whether they actually sell or not, at this point, well, that's what remains to be determined, but at least that is, for the period, what you have available in inventory, just sort of waiting on shelves, waiting to be sold. Now, what happens there? Well, the existing inventory, the cost of goods available for sale, will go in either one of two directions, and you see that at the bottom of that rectangle. Either they are sold, part of the units, accounting for the units that are sold during the period, at which point, that's the orange rectangle on the right. They are expensed as cost of goods sold. That portion of your goods available for sale that actually gets sold during the period. And then whatever doesn't get sold, well, as you might guess, it remains in inventory, and that becomes your closing or ending level of inventory for the period, which of course, as we then start the new period, begins is the same as your beginning inventory for the period to come, right? So this flow of goods, so to speak, this flow of costs should be, well, relatively self-evident, right? You start with something, you add to it, and then from that pool, you either sell it or you don't sell it. And if you don't sell it, it becomes ending inventory, right? This, in a sense, this is rather intuitive and easy to understand. So, obviously, the thing that we would say is simply it is possible, in theory, that every single unit in inventory gets sold during the period. And then you are starting at 0. But of course, that's really rather rare. And quite frankly, it's somewhat, from a managerial perspective, undesirable, because if you sell down to 0, it typically means that you didn't plan well enough, and so you have missed opportunities to continue selling if you had simply had more inventory. This, of course, presumes we're talking about inventory that generally can be retained to the next period and is not subject, for instance, to spoilage or obsolescence or those kinds of things. And in most cases, this is probably true. And so we really are looking at firms that manage the level of inventory appropriately from period to period, so there really is a beginning inventory and an ending inventory at the end of the period. Now, turning back to the slide, let us consider then, this is simply a photo I found that is trying to talk about some of the types of magnetic sensors that go into a typical electric vehicle. And so, as you might guess, right, most modern electric vehicles these days have a surprising amount of automation, which appears to the uninformed civilian, so to speak, right? The person just jumping into a car for a test drive, for instance, perhaps brand new, never test-driven an electric vehicle before. It can be somewhat surprising and perhaps even astounding, the amount of anticipation, the amount of sensors that are picking up your activity, perhaps even for perceiving your intent of what you want to do with the car, where you're looking, and those kinds of things. Well, as you might guess, the first time you perhaps test drive a Tesla or any other electric vehicle, the reason why it is sensing all those things is, of course, because of sensors built into strategic areas of the automobile to pick up all of this input, all right? And so the real question here is not, have you ever test driven an electric vehicle? The reason I have this slide here is take a look at all of the sensors that your typical vehicle manufacturer has to purchase in order to build one unit. Now, here's really the question. Do we believe in today's supply chain environment that the cost of these sensors from this period to next period is going to decline, that prices are going to drop for these sensors? And of course the answer is, well, right now, in the uncertain time of tariffs and foreign trade policy, right, we doubt very highly that the cost of any of these inputs is going to drop anytime in the near future. In fact, it probably can be said that generally speaking, we constantly anticipate from season to season, year to year, the cost of our production inputs is only going to increase from period to period. I think this is generally true, excepting for perhaps very large swings in business cycles that would, implode into things like recessions or depressions. Other than that, we seldom experience deflation of prices, right? The real job is trying to manage the level of inflation at a reasonable rate that can be managed and anticipated, right? So returning to the slide, if we consider, generally speaking, the cost of inputs continues to rise over time, then really what we are talking about in the next slide is how do we manage gross profit? Now, what do I mean by that? Well, let's first of all redefine gross profit. Just remind you, as we've already talked about, gross profit as a line item on the income statement. Gross profit is simply defined as revenue or sales minus the approximate or the commensurate cost of goods sold. Sales revenue minus the cost of those units, right, equals gross profit. Now, notice these two line items here, these next two bullet points. If higher cost units are transferred from the balance sheet, well, then that means if you're selling the higher cost units, then cost of goods sold is higher, which means if cost of goods sold is higher, your gross profit is lower. If, on the other hand, what you're really selling are the lower cost units, well, the lower cost units then are transferred to cost of goods sold, which means that your cost of goods sold is lower. That means your gross profit is higher. Now think that through for a moment. You have sitting in inventory at any point in time units that were built either with inputs that are of a lower cost to you, or as costs steadily rise, they're built with components that cost you more, which means that inherently some of your units will have a higher cost of goods and some of your units sitting in inventory will have a lower cost of goods. And what we're saying is, depending on which units you identify as having sold, well, it will actually result in a different gross profit number. Now, the reason we bring this up is not theoretical. The reason we bring it up, as you see here in the last two bullet points on this slide, is that according to generally accepted accounting principles, according to GAAP, companies have a choice. They have a choice when it comes to determining their cost of goods sold, the flow of cost methodology that they report. They have three choices for inventory costing. You see them there: FIFO, LIFO, and average cost. What the heck, more acronyms. FIFO is an acronym that stands for first in, first out, and LIFO stands for last in, first out. And so perhaps we really need to talk a little bit conceptually about what does FIFO and LIFO actually represent. Let us say that we are living in a typical environment where over time the cost of our inputs is increasing. Maybe not drastically, but certainly by the end of the period, the cost of purchasing components is higher for the same components than purchasing them earlier in the year. This is typical, this is standard, and so we would expect that, generally speaking, what does this mean? It means that units in inventory that have been sitting there longer, from, say, the earlier parts of the fiscal year, actually cost less than units that we have manufactured or produced most recently. Those sitting in inventory cost more. Now think about this for a moment. When we think about first in, first out, that means that what we are selling, first of all, are the oldest units, which is to say the lower cost units go out first, and then as we run out of those, we start picking units to sell that are of a higher cost, then a little higher cost over time. Last in, first out is, well, the exact opposite. It still deals with an environment, let us say for a moment, that costs over time, input costs are increasing. However, what last in, first out, or LIFO, presumes is we first pick from the front of the line. We first sell the most recently manufactured unit, which, by the way, has a higher inherent cost of inputs, and we sell those first. And then when we run out of those, we start picking all the way as we start to gradually make our way to the back of the inventory warehouse, if you will. Right? So then let us detail what this means financially or economically, depending on the inventory cost of flow method that we use for our costing. Returning to the slide you see here, let us take the example, this is from the textbook, of course, right? Let us assume the following inventory records. Now take a look at this. So on January 1st, let us say that that is the beginning of our fiscal year that we, for this particular company, our fiscal year runs from January to December, right? So December 31st was the end of the fiscal year, which means our beginning level of inventory on January 1st, that's the 500 units we had from last year. And those 500 units, we have a cost of $100 per unit, which, as you can see there, that means that our actual inventory cost for that is $50,000. 500 units at $100 each. And then let us subsequently say that during this year, we have also purchased 200 units. But as costs are rising, as is typical, this means that they cost $50 more per unit than the older ones. You can see there, we then do the simple arithmetic. 200 units at $150 per unit means a cost to us of $30,000. Therefore, we can say that the total cost of goods available for sale during the year, a total number of units of 700 units at a total cost of $80,000. Now you can sort of see how this all works out, right? It's really, up to this point, it is simple arithmetic. 500 units to start with, we added 200, means we have a total of 700 available for sale. $50,000 for the inventory that was already in our warehouse. We added those 200 units at a cost to us of $30,000. That means a cost to us total for all of the inventory available for sale of $80,000. Now, we also note that during the fiscal year, we sold 450 units, and we sold them at a sales price of $250 per unit, which means a total sales revenue of $112,500. That, of course, is very simple math. 450 times 250 each, $112,500. All right, now, here is where we begin to make a decision about inventory costing methods. In this example, if we use first in, first out as a flow of costs method on our income statement, then what we end up with is transferring costs from, first of all, inventory that is older, and then to the inventory that is newer. And as you can see there, costs from inventory in the order that they were initially recorded, which means the first unit that we sold was one of the older units at $100 that cost us $100 per unit. You sort of get the point, right? Which means that because we had 500 of those units available, and we sold 450, well, that means that all of the units we sold came from the older batch, right? Which means that you can see here in the little green rectangle right under that second bullet point, our level of sales was 112,500. All of the cost of goods sold came from the first initial lot that was beginning in our inventory, which means 450 units at $100 each, which means that the cost of goods sold was $45,000 for a gross profit of $67,500. And the detail on this, to understand this, is that FIFO assumes the unsold inventory, what's now left over at the end of the fiscal year, right, is the most recently purchased inventory, which is, well, to detail this, all of the 200 units that we purchased during the period at $150 per unit, well, plus 50 of the older units, because, of course, we had 500, we only sold 450. You do the math there, 200 times 150, 50 units times 100. That means we end up with ending inventory or goods available for sale for the next period of $35,000. And that's how that last bullet point comes out. Now, if you think through this is actually relatively straightforward and fairly common sense. You might expect for most companies, right? If you are, for instance, you're selling televisions, flat panel televisions, you will typically have an incentive to sell the older units out of your warehouse before you start selling the newest ones for a variety of reasons, right? There is perhaps obsolescence in consumer electronics as the time goes on. Manufacturers are pressed to always new and improved, right? There is, for instance, Apple every year is going to release another version of one of their devices. And so your incentive is to get your warehouse out of the older stuff before it becomes an undesirable, obsolete model, right? And of course, this is certainly true if you're selling perishable goods like a grocery store, right? If you have nectarines, you have a very direct incentive to sell the older nectarines as soon as you possibly can, right? With incentives if necessary, because at some point in time, nectarines no longer become old inventory, right? They become, well, unsellable, right? Inedible, right? So this first in, first out notion is perhaps the most intuitive notion because it generally follows the actual physical flow that we would expect for most companies selling product. And so next we turn then to this last in, last out inventory method. Let us first explain the differences in methodology, and then we'll talk about the practical reason why this is even an option. As you can see here, conceptually, in, last out, the primary difference is for the flow of costs, we presume the newest units in inventory are sold first. That's what it means, last in, last out. And so if you look at the first upper rectangle, you'll notice this is actually exactly the same as the rectangle in the prior slide because none of that part has changed. Beginning inventory from last period, 500 units. During the period, we purchased 200 more units for a total of 700 units. Cost to us, aggregate, is $80,000. And then we sold 450 units during the period at $250 per unit for sales revenue of $112,500. Where LIFO then differs from FIFO is in the second bullet point and the second rectangle. Remember, 450 units were sold, but this time under LIFO, for the sake of flow of costs, what we are presuming is that 200 of those units, in other words, all of the later batch of units, those sold first. And since we're in a sense picking from the front of the line, we sell all of those 200 units out at $150 per unit. We still have 250 more units we have to fulfill. So then we pick out that remaining 250 from the older batch. And you can see here what that means in the green rectangle. It means that our COGS is actually split into sort of two different categories or batches. The first batch, 200 units at $150 per unit, at an overall cost of $30,000, and then the remaining $250 at 100 per unit, which yields $25,000 in costs for an overall total cost of goods sold of $55,000, and therefore gross profit is lower. Gross profit is $57,500. Now, following this train of thought all the way to conclusion, this means that what's left for the next period? Well, LIFO assumes that the unsold inventory is, quite frankly, 250 units of the older batch, which means 250 units at $100 per unit, which means the cost of goods available for sale, in other words, remaining for the next period, is $25,000. Now, let us then take both of these slides and show you the differences. And that is what this table I built for you constructs, right? FIFO, the first row, is the first example I gave you. LIFO is the second. You can see there the level of sales is absolutely identical. However, there's a $10,000 difference in the cost of goods sold, which means under LIFO, the gross profit reported for accounting purposes is $10,000 less, and your ending inventory is costed the same number of units, but your cost is actually lower. So before we go on to any other topics, what we're seeing here is that consistently in an environment where costs are typically rising, LIFO results in lower reported gross profit. And what that means strategically is if you choose to select LIFO as your ongoing flow of cost reporting method, the way that we're going to report the costs of your changing inventory, you will consistently yield lower gross profits on your income statement. And you may think of that conceptually and say, why would anyone want to record lower profit? Isn't that unattractive to investors? Isn't that unattractive to lenders? Isn't that unattractive to anyone who would like you as an organization to make more money rather than less? And of course, as many of you have already presumed, the primary reason why you are reporting lower gross profit rather than higher is taxation. Because the one entity that would really, really love for you to see to report a very high level of profit is, of course, the Internal Revenue Service, so that they can tax you more. And so, generally speaking, last in, first out, as an option for the methodology you will use to report the flow of costs, is primarily and only a tax strategy in order to manage the level of gross profit you're reporting period to period. Now, returning to the deck for a moment, there is one other method that GAAP provides for you to report your inventories, and that is the average cost method. Again, this upper rectangle is exactly the same as the two prior slides. Again, it presumes the same historical inventory happenstance, where you began the period with 500 units and you added 200 during the period. The underlying costs to you are the same. You end up with 700 units at $80,000. But what average costing does, as you can see there, right in the highlighted rectangle, you simply take the total available number of units and the total cost, divide one into the other. You end up with an average cost per unit of $114 and essentially 29 cents. You use that number to approximate your cost estimation of cost of goods sold, and you end up with 61,071 as gross profit. You also use that same number to calculate the cost of the available inventory for next period, the ending inventory of this period of 28,571. And what you end up with really is a method which, as you might guess, FIFO results in the highest amount of cost of goods sold, and therefore the And so, as you might guess, of the three inventory methods, what you end up with is FIFO results in the lowest cost of goods sold and the highest level of gross profit. LIFO results in the highest cost of goods sold and the lowest profit. And average cost results in sort of the splitting the difference of both, the medium in between those two extremes of both cost of goods sold and gross profit for the period. We remind you, of course, at this point, before we go to the next slide, FIFO is simply an accounting methodology. Generally accepted accounting principles allow LIFO as an inventory reporting method, but that does not mean or suggest anything about the actual physical flow of goods. It is simply a taxation strategy to manage the amount of gross profit from a reporting perspective. Now, to confuse things even more, or to make things more complicated and challenging, the textbooks also points out a cost estimation method known as retail inventory costing, or RIM. It is important to note that while the textbook interjects it at this point, RIM is not an inventory costing methodology that GAAP allows you to use on your financial statements. It is simply a methodology that is used internally by the company as a companion to either LIFO, FIFO, or average costing. Now, to detail this, what it really means is that retailers with typically a very large number of SKUs or units that they sell will oftentimes use a retail inventory costing method to compute their ending inventory. And so what they will do is they'll take the units available times the individual retail selling price and calculate a cost to retail percentage, which of course has to be reviewed on a regular basis for reliability. But you can sort of see here what's going on, right? In the detail of the rectangle below, you could sort of see there is beginning inventory of, let us say, $100,000, and the actual retail selling price of all that inventory combined is $160,000. You add to that additional purchases of inventory during the period of $300,000, and that additional set of purchases has a retail selling price of $500,000, which means that if you follow the columns down, right, there's $400,000 cost of goods available for sale with a retail selling price of $660,000. That means a cost to retail percentage of 60.6%, and you use that as a calculation of your ending inventory at cost. Again, this is detailed on page 6.6 of the textbook, but does not represent a fourth method of cost flow assumption that you're going to use to report on your financial statements. It might be called out in a managerial note to the financial statements, at which point, as analysts, we need to review that information carefully, but it is not one of the three options available for the sake of generally accepted accounting principles. Now, as we were saying, going back to our three primary allowable methods, FIFO, LIFO, and average cost, this table from the textbook shows you what we had just alluded to a couple of minutes ago, right? That there are income effects from choosing a particular type of inventory costing method. For the same level of sale, if you use FIFO, your COGS will be lower and your gross profit higher. If you choose LIFO for a given level of sales, your COGS will be higher and your gross profit will be lower. And if you use average cost, you'll be right in the middle, right? So, the impact of FIFO versus LIFO has been somewhat minimized compared or relative to the past, as it says there in real life terms, because of relatively lower rates of inflation than some of the problem area times we've had in the past, And there is an increased management focus on reducing the level of inventory period through either more use of just-in-time inventory principles, through improved manufacturing processes, better inventory controls. And one of the reasons for this is rather obvious. As we mentioned, right, there are very large categories of assets that for most companies, right, are the very big ones. Goodwill, receivables, PP&E, and inventory, right? And the thing is, if inventory is sitting on a shelf gathering dust, there is certainly one thing it is not doing, and that is it is not earning you revenue, right? Why have your assets tied up on a shelf gathering dust? This is one of the reasons, for instance, why for organizations there is such a thing as having too much cash on hand, right? If you have too much cash, it's an asset that's not doing anything for you. It's not in the process of earning you revenue. The same is true with inventory. Why tie up an enormous amount of your asset base in a category that's just gathering dust rather than actively generating revenue? And therefore, the better you can manage down your level of effective inventory and keep turning it over, right, the lower your level of inventory in any one period will be, and as a result, the lower the amount of impact of FIFO versus LIFO and these kinds of things we're talking about in this particular deck. All right, just a couple more slides to go. So let us talk about the balance sheet effects of LIFO. As we have just said, LIFO inventory in a period of rising costs, LIFO inventory can be markedly lower than FIFO for the reasons we've belabored already. LIFO balance sheets do not accurately represent the cost that a company would incur to replace its current inventory. In fact, if you consider it this way, LIFO balance sheets and FIFO balance sheets are not directly comparable because of this vast difference in the way that this very large category of assets is actually valued. Therefore, GAAP says that if you choose to use LIFO, you also have to report in the footnotes, you are required to report in the footnotes, the equivalent FIFO inventory amounts, which basically means you got to get your accounting department to work twice, right? Because they not only have to report LIFO, they have to redo the calculations to reflect FIFO as well. However, when we talk about a difference in reported income and therefore savings on taxes, look at this footnote for the Caterpillar Heavy Equipment Manufacturing Company. Caterpillar in 2022 reported LIFO versus FIFO differences, also known as the LIFO reserve. And you can read that at your own leisure, but essentially what it says, look at this, at the very last sentence. If FIFO had been used rather than LIFO, inventories would have been $3 billion and $26 million higher than reported in 22 and 21 respectively. Now think about that for a moment. If those inventories had been that much higher, oh my goodness, what would the asset base have actually looked like? And of course, the implication is, what would gross profit have looked like? And you see here the tax savings that Caterpillar enjoys because of its consistent use of LIFO, right? Caterpillar has saved about $968 million in total taxes over time because of its consistent use of LIFO versus FIFO. And you can sort of see there the math behind it there. You could see that cumulative gross profit and pre-tax profit were lower by an enormous amount of money, right? $2.6 billion, which saved taxes and cash in the neighborhood of over $800 million through 2021. All right. Now, what does this mean? It means a couple of things. You can see here, strategic use of choosing your cost flow assumption is a viable and powerful tax management strategy. This is a very strategic choice, which, by the way, only applies to U.S.-based companies because IFRS does not allow LIFO as an inventory costing method. It also means that balance sheet comparability and transparency implies you have to normalize your financial statements first. You as an analyst, if you are trying to compare two companies, only one of which uses FIFO, you have to normalize the other financial statement first in order to compare this very large aspect of assets, this category of inventory. Also note that the retail inventory method is a scalability solution. It implies that GAAP recognizes the economic practicality that different industries bring to trying to actively cost and determine the cost of their active inventory that they have at any point in time. All right. Again, what we are trying to do is provide some foundational understanding how to analyze this very, very significant and large category of assets that we will find as we begin to look into what is really the financial health and strategic managerial efficiency and wisdom in managing large categories of assets. All right. I hope that's helpful, and we will see you in the next video.